Welcome to Thoughts on the Market. I'm Michael Zezas, Global Head of Fixed Income Research and Public Policy Strategy. Today, we're talking about the U.S. and China, why the relationship remains complicated, and what it means for markets. It's Tuesday, October 21st at 12:30 p.m. in New York. If you've been following headlines, you know that U.S. China relations are rarely out of the news. But beneath the surface, the dynamics are more nuanced than the daily soundbites suggest. Investors often ask, are we headed for a decoupling of the two economies? Or is there room for cooperation? The answer, as always, is it's complicated. Let's start with the basics. The U.S. and China are deeply intertwined economically, but strategic competition has intensified. Recent years have seen tariffs, export controls, and restrictions on technology transfer. Yet there's still plenty of trade between the two countries, and both economies are dependent on each other for growth and innovation. So what's going on now? In recent weeks, China has moved to tighten rare earth export controls, and the U.S. has proposed 100% tariffs in return. If this came to pass, these events could mark a clear economic split. But given the interdependencies we just cited, neither Washington nor Beijing seem eager for a true split, at least not anytime soon. The economic costs would be staggering, and both sides know it. So a truce seems more likely, perhaps with somewhat different terms than the narrow semis for rare earths agreement that they made this spring. And longer term, this episode seems to be part of a broader dynamic where rolling negotiations and truces are more likely than either a durable trade peace or a hard economic decoupling. For fixed income investors, this drives some important considerations. First, U.S. industrial policy is ramping up with clear implications for AI infrastructure. AI is an area where the U.S. views it as essential that they outcompete China. Supported by renewed CapEx incentives from the latest tax bill, it's clear to us that U.S. companies will be pushing further into AI development, where my colleagues have identified $2.9 trillion of data center financing needs over the next 3 years, about half of which will come from various credit markets. And for credit investors, this presents an important opportunity. Another consideration is how markets will balance near-term growth risks with an array of medium-term growth possibilities. As our U.S. economics team has pointed out, the evidence suggests that corporates haven't yet been forced to make tough decisions about passing on or absorbing tariff costs, underscoring that trade-related growth pressures aren't yet in the rear view. The ongoing U.S. government shutdown doesn't help either. It's all a good argument for why bond yields could move lower in the near term. But also, we should expect yield curves could steepen more, with higher relative yields and longer maturities. This would reflect greater uncertainties around higher fiscal deficits, inflation, and economic growth. Our economists have been calling out the mixed messages in economic data, as well as a U.S. fiscal sustainability picture that appears reliant on acceleration in corporate capex for a manufacturing and AI-driven growth burst. In sum, the U.S.-China relationship is evolving, with global implications that don't lend themselves to easy narratives or quick fixes. Our challenge will continue to be crafting investment strategies that reflect durable policy undercurrents, the signal amid news headline noise. Thanks for listening. If you enjoy the show, please leave us a review wherever you listen, and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.